Welcome everyone to the live video for the Gamma Optimizer room. As usual, I'm just doing a quick check here for audio and video. You can type on the chat window. That would be fantastic. Like someone can just confirm that we have good audio and good video. I'll wait. I think there is a latency between me asking questions and you saying. Maybe let's type it here. Okay, so I have an all good. Okay, so let's start with the presentation. Thank you, Gio. Okay, so it's only like a few guys today, but I will save it later on for anyone that wants to see it. As long as I have at least one person watching, I guess it will be perfect. Okay, so let's start this video. But keep an eye on the questions that you have on the side, just in case you have any questions. Okay, so let's talk about the VRP 350 system. Has been really hit and miss lately. We got 3 losses and 1 win last week, and this week 1 win and 2 losses. So it's been like terrible, like 5-2 basically. And if I measure performance across several time frames, then you'll notice that it's really underperforming across pretty much anything. No, it is underperforming across the 10-day. It's a 50%, so it's basically a scratch. The last 10 trades has been a scratch, basically. And since we started doing it in February, it's 50.48. Which is not good at all. I mean, like it should be around 63, higher than 63, pushing to 64. So clearly the system is underperforming. It could be something transient, or it could be something more fundamental. It could be just that whatever is the pattern that the system was trying to follow has evaporated since last year. Okay. The thing is, in order for the performance of the system to recover, we will need to see probably like 6 trades in a row or more of winning. Like winning several trades in a row, and I don't know, I don't see how that can happen, in particular with the market changing direction so fast. Now the market doesn't seem to be able to hold a trend that long, but we'll see. But in my personal case, my plan for the system is I think I'm going to discard the system pretty soon, probably within the next month. I'm going to give it a few, like 1 week or 2, and then I'll switch to something else. No, I guess it was an interesting run so far. At least it's not losing money. Well, I mean, for those of you that have been doing it since from the beginning, it hasn't been losing money. So at least it is there. You know, it was a roller coaster trip, and it's delivered like exactly in a scratch, basically, since we started doing this. There could be other variations that are more successful, but I'd rather replace it with something fundamentally different. And I'll talk about that a little later on. In terms of market regime, okay, so the market is interesting. The GT level is at 4,092, and we remain in a short gamma regime after a brief long gamma flip. Now we flip long gamma a little bit, and then we are back at short gamma. We have been at short gamma for 2 days in a row. I wasn't expecting the move to be this fast. I was expecting the long gamma regime to last probably until next week, and then the Fed meeting being the final nail in the coffin for the long gamma, the perfect excuse to flip short gamma. But I guess the CPI number were so bad that they kind of like provided that in advance. No, I was expecting the Jay Powell to be the one to remind the market that they are going to keep tightening. So anyway, so in any case, we are back in short gamma, and September has been really volatile, you know, like extremely volatile, and those were the expectations. Remember that we expected September to be extremely volatile, and so far it hasn't disappointed. Even though intraday realized variance doesn't seem that high, close-to-close volatility is extremely high. Okay, and also we should see normal trading volumes returning very soon, and that's another equation here, like if we get like normal people reallocating portfolios and trading volumes that are consistent with the last quarter of the year, then we should see even more volatility, no? and we should expect to see liquidity even more scarce than what it is. So that's kind of what I'm expecting here in terms of the GT level. I don't know when we'll flip long gamma again. No, I don't think that the long gamma regimes have been consistent in 2022. I think the longest one lasted like 1 week or a little longer than 1 week. So long gamma has been scarce this year, and I expected that being the situation going forward into 2023. In fact, I am going to tell you my hypothesis. My hypothesis is that long gamma is going to be really scarce, it's going to be really brief until such a time when the Fed starts reducing rates again. No, I guess that's what it is. I guess we got spoiled by a big period of liquidity-induced stimulus that kept the market long gamma most of the time. Okay, so let's look at volatility. So you can see right here that in the last month, realized variance close to close measured from 4 p.m. to 4 p.m. has been 26.11%. It's like outrageous. But even more outrageous is the weekly. The weekly variance is 38.55, which is kind of crash levels of realized variance. Of course, it's related to the big move we saw yesterday. We saw a gigantic move in the market, and it is reflected right here in volatility. So any value, monthly or weekly, those values are extremely elevated. It's excessive realized volatility. It has been the story of the whole year, and VIX is doing nothing. VIX is at 26.35, is massively underpriced. The market really is not pricing correctly the risk. So this is something I'm going to talk a little bit later too. So we have a situation here. Either VIX is just reflecting the true market, and market participants are really not concerned at all, or there is a methodological flaw in the way that VIX is being computed this year. I mean, it's a methodological flaw since VIX was invented, but only this year we are seeing the flaw in action, because I cannot believe that option dealers and then volatility players are underpricing risk at this juncture. You know, but if we take VIX at face value, it looks like market participants are really in denial. No, they are just in denial in terms of near-term volatility for the markets. Okay, and remember, folks, you can interrupt me anytime you want for this presentation. In particular, in YouTube, that it takes longer for the questions to arrive. Okay, looking at the term structure, here is the thing that is really surprising, that we have a move that hasn't happened in the past 2 years, basically. You know, we have a 4% down day, and yet the term structure looks so normal. Like, compare the term structure from last week, which is the red line, versus the term structure today, and it's pretty much the same. No, it is up just a few volatility points. It's not massively up, and the only thing that is interesting is just a little inversion. Not much, but a little inversion of the curve around the FOMC meeting. I will invert it even higher, because now we have the potential of a negative surprise in the Fed meeting. Like the Fed could tighten even higher than the market expects. No, so I don't understand this volatility. They seem too low for the true risk. So these levels of volatility don't seem really corresponding to reality, and they might open the door for a trade. And I mean, like, I'll measure this again next week, and I think based on where we are in volatility, we could do a trade, because these levels will allow us to trade something, and we could trade I think we could trade the Fed meeting. No, we could do a trade of the Fed meeting and see if we can do something there. In particular, I will trade long volatility. I will go long volatility, long implied, long realized around the Fed meeting, because I think that even though it's a little expensive, it's not as expensive as it should be. Okay, so the term structure is weird, and I guess dealers are really sanguine with this, or they are really comfortable with the current pricing. That notice that they didn't reprice risk that much, even though we have a big move. The same thing with realized variance. No, realized variance has to be interesting because it became really unstable. It has been unstable now for a while, and this week is also a little unstable, but not that much. It's still below the 20% level that we always track. So liquidity has been kind of decent, for the type of moves we have seen. It was decent. In fact, yesterday you noticed that we have all this, the dump in the market, and intraday realized variance wasn't that high. It was less than 20%. The only thing is that VIX is starting to wake up, but it's lagging massively. Realized variance is waking up very little, and again, I am really concerned about this. I'm really concerned that market participants are not taking this seriously. No, and I think that we should. I mean, we really should take seriously that the Fed is going to tighten even higher. I guess maybe this is a credibility problem. Maybe no one believes the Fed. Maybe no one believes that they have what it takes to actually control inflation, and that they will reverse course pretty soon. I don't know. I think the market is in for a rude awakening, and in the coming weeks. No, like once you see the result from these guys, and once we get the minutes in October, I think those things will provide extra encouragement for those that, like me, that think that the market is not pricing correctly the risk of a recession in the near term. Okay, so this is in terms of realized variance. In terms of variance risk premium, this was expected. We expected, it was obvious that variance risk premium was going to flip negative, and sure enough, it flipped negative, and in particular with the action yesterday. I don't think anyone was pricing a 4% single move in a single day, a move in a single day. No one was pricing that. And again, it's like 9 months into the year, and if you notice this graph that goes back to 2020, I notice how peculiar 2022 is. I mean, variance risk premium never got higher, never approached 100%, never. I mean, volatility was never twice realized variance, and in every other year it really touched 200%. No, it's really, they were like really high volatility values, but in 2022 we didn't get that, and that's something that we need to analyze, and it's something that maybe I'll keep an eye for academic papers, because I am not the only one noticing this. Of course I cannot be the only one noticing this. This makes no sense. It makes no sense that dealers that are underwriting risk are underpricing risk. Why will they underprice risk? And also, like, it's okay. I mean, you can underprice risk for a while, but you quickly adjust, and you can see in the previous years, you can see that whenever variance risk premium went down, then it corrected easily. It easily corrected to really high levels. But this year it has not corrected. Just a couple of tries, and that's it. And why? What is the force that is keeping variance risk premium so low and negative in 2022? I can't see anyone making money of this. like if a dealer is actually underpricing, they are going to lose money. And if someone is actually selling volatility as a strategy, they are losing money too. I don't understand why it's so subdued. Unless there's someone that is shorting volatility is just a massive amount of retail traders. That's the only explanation. Maybe there are tons of leverage ETFs are being used by retail traders to short volatility directly or indirectly, and maybe that's what is happening. But that's very interesting. So I again mention VIX. It makes no sense. It makes no sense. Like, truly, it makes no sense that options are so cheap at this juncture. Like, I don't know what is keeping options really cheap. I don't know. I could just throw some things here for you guys to think about. It could be that we have too many options now. That before we only have a few, and now we have tons of options. So maybe that is creating some competition for certain lines, and dealers are kind of underpricing a little bit the risk, or maybe because it's easier to manage risk now than before, then variance risk premium is being lower this year. But I think this is the thing that is concerning me the most, is that the VRP has been a constant since 1987. Variance risk premium has been a constant, and it is at the risk of disappearing this year. It is. If we continue like this, 2022 will be probably one of the few years that the variance risk premium wasn't positive. And I wonder if that maybe whoever is dealing in volatility discovered a better way to hedge options, and maybe it's going to disappear, no? So anyway, that's kind of my rant here about variance risk premium. I know that in the room we do a little bit of it, but in general, if it disappears, then we need to figure out something else to do, no? We need to figure out what to do instead of extracting variance risk premium if it goes away. Okay, and the same thing with ambiguity. Ambiguity is also concerning to me because notice how low ambiguity has been through pretty much all 2022. Compare that with any other year. Compare that with 2020, compare that with 2021. Ambiguity always goes up, always goes up. And in 2022, it has been like pretty much around 0, 0.09, 0.1. And for those of you that understand a little bit about ambiguity, remember that it kind of measures autocorrelation in the market. Now it's a proxy for autocorrelation. It's a proxy for the variance of variance, basically. And the fact that it's so low means that this year returns have not been that autocorrelated. And that's kind of surprising, and maybe that is connected with the disappearance of variance risk premium, and maybe all connects together. Maybe everything ties up. That 2022 has been a year where all of these really stable patterns are disappearing little by little due to who knows what reason. So if autocorrelation is disappearing, now if autocorrelation is actually not working in 2022, it has an impact on the things we do in the room. In particular, it has an impact on all of the neural nets. And in fact, it will have an impact even for hedge funds, like classical volatility hedge funds, because autocorrelation is at the core of pretty much every volatility model, you know. And if autocorrelation is out of the window this year, or it has been, let's say, substantially less efficient than it has been all of the other years, then that means that we need to change the tools. And this could be one of the reasons why all of the ultra trades are underperforming a bit this year, because we rely on autocorrelation, we rely on volatility to have clustering effects, no? We rely on mean reversion, and it doesn't seem to be happening, no? It doesn't seem that is happening right now, at least measured by ambiguity. So this is another thing to consider, another thing that I have to consider when I design the replacement for VRP 350. I need to create something that is less sensitive to autocorrelation, maybe something that even doesn't use autocorrelation at all, you know? So for now, I am just keeping an eye, but like 2022 is turning out to be a very interesting year. You guys have not asked the question about like how it looks like the autocorrelation goes away. So the thing with autocorrelation is that one of the biggest, okay, I finally have a question or a comment. It says maybe it's because volatility for 2022 has primarily been from Fed action, which can be predicted within a semi-tight range, whereas 2020 volatility came from a completely unexpected event. That could be done. It could be the nature of where volatility events are coming, but it's also a consequence of the action. If you look at the action, you know, one of the key components of autocorrelation is clustering. So that means periods of low volatility are followed by periods of even more low volatility. I mean, low volatility continues, like regions of low volatility extend and extend until something disrupts the low volatility. And the same thing with high volatility. You have high volatility, and then you have the disruption lasts longer. No, it stays there. It clusters. High volatility clusters together, low volatility clusters together, and then what you have is these transitions between the two regimes. So you have a low volatility regime that persists, and then you have a high volatility regime that persists, and it's forever and ever transitioning between the two, always reverting to kind of a mean. But in 2022, it seems amazing. No, we might have a very high volatility day, and then the next day is low, no, and then the next day is high, and then the next, like, there is no transition. It seems that it's like an on-off. It seems that in 2022, volatility has been pretty much like on-off, right? A binary type of thing. And yes, it could be like Dan mentions, it could be because it's related to volatility being induced by exogenous events. No, so if you have an exogenous event that it surprises everyone, then it just goes on like a little flip. And then the next day, I don't know what happens the next day. No, like look today, for instance, how low all the volatility readings are. No, so it is interesting to see that. It is interesting that autocorrelation is disappearing, or it could also be just a consequence of how information is being propagated. Maybe before information had a higher inertial level. So it took a while for market participants to get the correct information. So maybe that's why volatility persisted. These volatility regions persisted because market participants were reassessing new information, and it took a while. There was an inertia. Maybe the inertia right now is really fast. Maybe the inertia right now lasts less than one session. Maybe one session is more than enough for market participants to reassess what is going on. So that kind of regimes, of course, messes up with anything, because pretty much all my neural nets, the neural nets we use, Ultra and Supreme and Ultra 3, all these things, they are looking for these autocorrelation periods, and that's how they are forecasting. Like at the end of the day, you cannot see the future. No one can claim that can see the future. No, the neural nets don't see the future. The only thing we do in the room is we just kind of identify what is the region we are, and we assume that in the next 5 sessions or 3 sessions or whatever, it's going to be very similar. But it turns out it hasn't been like that this year. And I don't know. So this could be a true change of nature of the market, like the market really changed due to communication tools, due to the way information is being processed, due to the fact that the Fed is removing liquidity from the market, and now we are more dependent on external events. I don't know what it is, but it is worth keeping an eye on it and see if we can adjust. If it really becomes on and off, then we'll have to figure out a different way. Maybe the neural nets now will have to consider these exogenous events. Like, for instance, the neural nets, for the longest time that I have been training them, don't consider the Fed schedule. I don't have the Fed schedule in there, and I don't have any kind of economical schedule into a neural net. Like, I really don't. I never do that, because they were just kind of periods of little noise, and more or less whatever was happening in the market was all due to correlation. But now it seems that there are massive effects about like all these data dumps. Whenever we have any macroeconomic data coming out, we get these really huge effects, and maybe I will need to create neural nets that incorporate that kind of calendar into the equation and figure out if there is a pattern then or not. Anyway, that was the rant. I wanted just to complement everything here for the rant. So in terms of the trade plan, BRP 350 remains within parameters, but I am kind of losing patience with the system. At least it's better than in other occasions where we are like massively red, but we are still a little green on the system. But I mean, this is starting to depart from the long-term trend, and really we need to keep an eye on it. In terms of new systems, I do have a couple of new systems. They are not completely new. I mean, I always use them myself, but I have a couple of systems that I would love to bring to the room, and I am looking into them. And I think the main parameter of those systems is that they have to be like really short-term duration. Okay. The problem with all of the systems we have doing that the last 5 days or the last 3 days is like we saw yesterday, like before the CPI release, all of the trades were working perfect according to plan. And then we have a mini black swan event, and it kills 3 trades in a row. Like all of the 3 trades got destroyed because there was this event that is impossible to predict. No one knows what is going to come on that report. And so we need to come up with a system that is either doesn't have overnight risk, if it has overnight risk, then something that only has 1 night of overnight risk. Okay, so the ideal system is either a 1-day system or an intraday system. That's kind of the ideal system, because then the trade is self-contained, it's really fast, and then we can go to sleep, and if something happens, only 1 trade dies or no trade dies. So this is what I'm doing, and I'll be introducing one probably just before the Santa rally, if we have a Santa rally this year. So let's take a quick look at the variance center before dropping the meeting. And I forgot how to use this because I'm using YouTube, and for YouTube I use a completely different setup. Okay, so here we have this thing. So notice that we are massively short gamma right now. We have huge imbalances. We have 34 billion of notional, 43 billion of notional in the way down, and that is a sign that we should expect huge volatility in the near term. And realized variance is elevated. I know that we think that 17 is not elevated, but it's very elevated. No, it's very elevated. It's just that in 2022 looks low for 2022. But it's elevated, no? It is what is expected in a short gamma regime. In terms of the gamma imbalance per strike, it's interesting because there is a fair amount of puts around 3,900, and there is a fair amount of puts around 3,800. And that's kind of interesting. So, and there is nothing else, you know. If you look upward of that, there is very little in like 3,950, and then from that point on, there's almost nothing. It seems that pretty much everyone localized hedges around 3,900 and 3,800. So it's kind of interesting, and it's kind of dangerous because remember, we are in a short gamma regime, and these hedging walls in short gamma act as accelerators. If price organically tries to move towards 3,800, that move 3,900, that move will be completely accelerated, like ultra accelerated. So the potential for further losses is there, you know, and there is a heavy. You can see them. There's a heavy like in 3,900 and 3,800. So the market could quickly accelerate towards 3,800, and that will be a good like trade plan. For instance, we could play something way below 3,800 for next week. You know, we could play something like that and see if we can do it with either optionality or with depending on implied volatility explosion, like doing a calendar trade. But that's something that I'll design later this week before we go on Friday. And I apologize for missing the downside trade that I was expecting to do this week, but everything happened too fast. So that's it. That's it in terms of the variance center. I see here, it's very interesting that VRP 350 has been so bullish. And I think it's kind of natural. I guess, I don't know how it is working internally, but my guess is that it looks at periods of drawdowns, and then it always assumes that a bounce is coming. It's a fairly easy pattern to deduct from the market, and I think that's what VRP 350 is doing. I am taking the trades because that's what it is. We have to take the trades and see how they work, and I promise I will never interfere with the trades again. So I'm going to take the trades until until the net goes outside the design parameters. And I have a question. I did take a look at a couple of put butterflies centered at 3,900 for the end of the quarter, trading about 10x and 15x. That's not bad. I mean, butterflies at theoretical 10x will deliver probably 3x, in real life. So that's not a bad trade at all, depending on the price. And downside butterflies work really well. I was thinking more about a calendar spread, like the ones we did unofficially around the end of the summer. Remember, that one was also a very decent trade, like no drama type of trade. So I was thinking about something like that, like no drama type of trade, that if it doesn't work, we are pretty much a scratch or very small loss, and if it works, it's gonna deliver like nicely like the previous one. So I'll keep post you guys about this, and I think that's it for today. Let me see what else I have here I don't have anything else. So thank you folks for attending this impromptu meeting, and I did it in the middle of the week because I wanted to capture a little bit of the current action, and also because I owe you one from last week. So if we have like a meaningful action today, tomorrow, and the day after tomorrow, I do another one on Friday. Otherwise, this will be like it will be the meeting that covers both weeks. So thank you again for attending the meeting. I hope you have a great day, and I'll see you guys in the room. Take care, everyone.